Well, the role of Fed Chair for Kevin Warsh is getting an early challenge as the bond market is seeing yields hit levels not seen in the last 20 years. The challenge is that Warsh wants to hold the 2% inflation target, and rising yields in his mind mean fiscal tightening is underway, and that will lead to lower inflation without actually having to impact interest rates. So, how will Warsh deal with all of this right now? Plus, as well, there is the component of what he is saying and what he's not saying about the process. Wharton finance professor Nick Roussanov joins us to discuss what lies ahead. Nick, great to catch up with you again. How are you, sir?
Hi, Dan. I'm great. Thanks again for having me once
Thank you.
again.
Yeah,
Always a pleasure. Yeah.
and so let's start with that 2% target rate and whether or not it is still feasible with everything that's going on in the economy to expect the Fed to actually get to 2% at some point in the future. And I say this because as all of this has been going on, and me as a journalist, I've wondered whether or not it ended up, we would see it be 2.3% or 2.5% be that magic number down the road.
Right. It doesn't, of course, have to be the magic number, but I think the market has expected for a long time that the Fed would do what it takes to get it as close to 2% as they can and kind of stay within the reasonable range. And it's not impossible. Inflation slowly has been creeping down, right, over the last few years. And yes, the Iran war has kind of thrown a bit of a wrench into that. Oil prices have been volatile. But we know that energy prices generally are kind of the more volatile component of inflation, and that's part of the reason that the Fed typically focuses on the core. And the spillover from energy to core is not always kind of direct. However, if kind of these inflationary pressures in energy continue, that will, of course, eventually make it way into the core as well. And of course, the other side of it is the AI buildup, which has also been driving up costs kind of across the board, has also been contributing. But again, as
Right.
we've seen in the most recent reading, inflation has kind of softened a little bit. So there is hope that we'll get there. The keys for the Fed actually to do what it's supposed to do to ensure that.
What kind of impact then is the most recent run on the bond markets having to all of this component?
Right. So this is where it gets interesting because what happened at the last FOMC meeting or after Kevin Warsh's press conference is that the market really got spooked by his language. He did not just didn't commit to a path of rates. We sort of knew that that was not his thing. He was going to step away from forward guidance, but he just gave a lot of very vague talk about yes, he's committed to bring inflation to target. He'll do what it takes, but what actually that would be, and kind of what are the goalposts that he's trying to hit? Are they shifting? That's I think
Right.
it created a lot of uneasiness. He's talked in the past about his trimmed mean inflation, which works slightly differently from what we normally use. It's a little, it shows up a little bit softer. And I think this kind of lack of commitment to what people call a reaction function rather than necessarily just the path of rate. I mean, how will the Fed react if numbers come in at a certain level for employment and inflation? I think that's what gave the markets the uneasiness that drove much of that run up in rates that we saw following that press conference.
And you're also talking about a time where the announcement by Scott Bessent to want to increase the buybacks as well, using that as a tool as part of this process to be able to kind of ease some of the fears.
Right. So here it's almost like they're working at cross purposes because Kevin Warsh said, "Well, I don't necessarily have to raise the rates at the short end because the market is already doing it for me on the long end. As
Right.
long yields are rising, that is putting brakes on the consumer. Eventually, that will put brakes on investment, and that by itself will help kind of keep inflation in check." Now, it's first of all that it's getting it a little bit backwards because the reason that the rates rose is because of this an extra uncertainty injected by the Fed not committing to the path of short rates. But be that as it may, Besson trying to push rates down, of course, will undo whatever disciplining
Yeah.
kind of effort that Warsh was hoping to extract from the bond market, right? So now the bond market is not doing his job. Now he has to do his job. Now he actually has to react at the short end of the Fed funds rate. And so the two are kind of working at cross purposes. Now, so far, the best in action hasn't been that effective. The yields went right back up the day after,
Yeah.
basically. So we'll see. It would take quite a bit of an intervention to sustainably push down long maturity yields, but it's not impossible in principle. We know that PQE sort of worked. It didn't work maybe a whole lot, but it sort of worked to push rates down. That was done by the Fed. The Treasury could, in principle, do something like that, but of course, its ability to do so is limited because the deficit is what it is, right? I mean,
Yeah.
so there's nothing you can do about it without cutting the deficit.
But what's
You have 40
interesting
trillion of debt.
what's interesting is that you also have Kevin Warsh trying to remake the Federal Reserve with the committees that he announced a few weeks ago in looking at how they should be looking at data. There's been conversation for a while of whether or not the Fed is too backward looking in terms of making the decisions going forward. And so he believes these committees will help the Fed kind of take a different path for the longer term future.
I think it's always good to reevaluate how things are done and whether the best process is being followed going forward. So, he's a new man in charge, and he wants to do things his way. And part of that is maybe breaking with a little bit of kind of status quo groupthink that maybe exists at the Fed, and again, reevaluate kind of the process. I
Right.
think that by itself is just fine. Perhaps they can come up with a better process, but in the end, the data is what it is, and the markets see what the markets see. Yes, the Fed maybe has some data that is not easy, but ultimately, the market is the accumulator of all information in the world, and we
Yeah.
see that the bond market is not happy with this language, and the bond market is not happy with where things are going, both on the monetary front and the fiscal front. And something, at least on the monetary side, we kind of know what has to be done. Inflation fighting credibility has to be preserved. And that may help keep the long bond yields in check somewhat to the extent it is possible, given the fiscal situation.
What does this mean then for Wall Street? And is Wall Street getting a little bit of a different view now of what Kevin Warsh is trying to do as he move forward, and Wall Street is going to have to react to that?
Yeah, I think there is definitely reevaluation of what monetary policy will look like in the near future. I think he lost a little bit of credibility at the last meeting. Now, subsequently, inflation did come in a little bit softer. Employment numbers came in not particularly strong, so that
Yeah.
buys him a little bit of time to reestablish that credibility, and maybe that there was some hints of that at the time of the FOMC meeting, and that's why they voted the way they voted. But again, if we see a pickup in inflation numbers, and he still doesn't react with anything other than kind of very vague words, I think the market will punish him, and I think the yields will rise even more.
Great to have you with us today, Nick. Thanks very much for your time today. All the best.
Of course, thank you very much.
Thank you, Nick Roussanov, who is a professor of finance here at the Wharton School.